From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm David Moss from Fox 8, guest hosting the Financial Quarterback.
And I'm Jim Lineweaver, your financial quarterback since 1993.
Okay, so we've known each other a little while. You've been doing the show a couple times a month or so, and we always talk about other things that people call us about, have some questions. And we thought maybe it'd be a good idea to maybe personalize this a little bit and start something called Stump the Quarterback.
Exactly. So it's not just on Sundays, but now it's going to even play after football season.
Yeah, so this is where you can address a problem, and Jim can show you how Lineweaver can help you out.
Yeah, and this is where this coordination comes in that we always talk about. So recently we actually had a client who had a 401k. They were retiring from their work, but they had a lot of company stock in it. And they were traditionally just going to go right to a self-directed IRA, but the tax ramifications for their future retirement were not going to be in the best scenario.
So when you turn that stock into money, you might not be doing the best thing and putting it in the right place.
Well, this is when it comes to what's called net unrealized appreciation. So if you work for a publicly traded company and you have employer stock in that plan, if you roll it over to a self-directed IRA, then down the road, you're just going to be taxed at your personal income rate. Whereas you have an ability just with company stock to be able to roll this out, pay tax on what's called the cost basis, and potentially get some lower capital gains on the balance.
So you decided to do this. This isn't something you just do and get it done with. This sounds more like a two-part thing.
It is, and you have to be very careful, and this is where you want to get a tax expert in too. So this is where we're coordinated with Mark in our tax department. But basically, to give you an example, let's say somebody had $300,000 worth of employer stock in their 401k, but though through the years, maybe the last 20, 30 years that they were working, they only paid $100,000 for that stock. The other $200,000 is appreciation. They can roll that $100,000 out and pay personal income tax on it. And if they want to go ahead and sell all $300,000 worth of stock, that's fine, but the other $200,000 would be taxed at a lower capital gain rate. Or they could also wait 12 months to sell some additional stock. But traditionally what happens is your highest marginal bracket's about 37%. The highest capital gain rate right now is about 20%.
Oh.
So you could almost cut your taxes in half.
So it's all about the capital gains. I mean, that's why you need a whole team to get in there and divvy this job up, because it doesn't all happen at once. You got two parts of this thing. You address it and you deal with it, and it's all about the capital gains in the end.
And it's not just about capital gains. It's the difference between your personal income rate versus capital gains and how you take this money out in retirement. Because in this scenario, it could save this person about $34,000.
$34,000. Now that's a lot of money.
It is, especially in retirement.
So hey, if you have questions for Jim about your finances, how you can help maximize your retirement, minimize your taxes, and everything in between, you can ask. And we may answer live on the air too. That'll be a lot of fun. And to submit your questions, just go to lineweaver.net and look for the graphic you see on your screen right now on the lower right and get good answers to your tough financial questions today.